Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Steve Saretsky, a Vancouver-based realtor, online at stevesaretsky.com. Welcome back to the show, Steve.
Always a pleasure. Thanks for having me on.
Steve, what is the B20 mortgage stress test, and what effect is it having on the real estate market?
Yeah, so the B20 mortgage stress test is essentially a test that's put in place by the financial regulators of the banking system called OSFI. And what it is basically a 2% stress. It's basically a 2% rate increase on top of what you normally qualify. So in simpler terms, let's say you're going into RBC and getting a 5-year fixed mortgage today at, say, 3.5%. What they'll do is they'll assume that the rate is going to be 2% higher. So they're going to qualify your borrowing capacity on the assumption that the rate that you're going to borrow at is 5.5%. Even though you're going to borrow from RBC at 3.5%, they're going to assume that you're actually borrowing at 5.5%. So what this effectively does is it's basically a buffer to ensure that, you know, if rates go up when you go to renew, you know, that you can basically afford that, because obviously we have interest rates at historic lows. And so what this ultimately does is when you qualify people based on that assumption, you're effectively reducing their borrowing power by roughly 20%. So, you know, you can obviously imagine that when prices are at sky-high levels, you're reducing people's leveraging abilities. That's automatically going to impact, you know, buying power and thus prices. And I think that's a huge result of the slowdown that we've seen here in Vancouver.
Was it necessary to bring it in?
I think it was. I think it probably realistically should have been done years ago. We've had, you know, historically low interest rates for a decade now, abnormally low. They've probably waited too long to raise them, and now I think they're stuck in a position where you can't even really get to 2% without a lot of things starting to deteriorate. But yeah, I think realistically that probably should have been put into place before prices rose, you know, 50, 60% over the last couple of years. But, you know, it is what it is, and regulators tend to always be reactionary as opposed to proactive. And I think that's where we are today.
What would play a larger role in the real estate market downturn, the constriction of credit or the mortgage stress test?
I think they actually go hand in hand. I mean, when you're reducing people's borrowing, you know, capacity, it actually, you know, as we can see, it's curbing mortgage credit growth. So mortgage credit growth, is growing at its slowest pace in 18 years. And so it's no surprise that coincidentally, Vancouver home sales for the entire year of 2018 finished at an 18-year low. So, you know, I don't think most mainstream, you know, pundits on the housing market, everybody always talks about housing supply. We're not building enough supply. But if you have an unlimited amount of, you know, mortgage, credit chasing a finite supply of homes, those home prices are going to continue to rise. So you actually really have to restrict the amount of loans that people are getting and the amount of leverage that people can take on to actually, put a damper on home prices.
With or without the stress test, if financial institutions become fearful of the real estate market, are they likely to really choke credit?
Yeah, it's pretty typical of sort of financial bubbles. Is what you generally see is, again, this isn't really in any asset, but asset class, but I would say probably real estate in particular, is in order for you get sort of euphoric price rises, you actually need an inflow of credit. And a lot of that is usually generated from banks. Banks react very similar to any other person, as in when home prices are rising, they are encouraged to lend more money. It feels very safe. You actually have what's deemed a more creditworthy borrower. because they have leverage in their home prices. Incomes are generally growing along with that, because a housing boom is generally correlated with a strong economy. So you basically, what happens is the banks basically lend into the boom, and then as things start to reverse, as the more negative news headlines come out, banks have to basically still start tightening and adjusting, their lending requirements, et cetera, and that's what we're seeing. And then as you'll start to see, now with home prices starting to decline, this ultimately impacts the banks' capital ratios, and so they have to start adjusting for that. And basically what happens is when you basically need banks to start lending, in order to sort of counteract the decline, they actually get tighter and tighter. And so there's that old analogy that, a banker will give you an umbrella on a sunny day and they'll take it away on a rainy day. And I think that's kind of indicative of banking behavior.
We'll have more with Steve Saretsky right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTC QB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Steve Saretsky. Steve, at what point in a real estate downturn are banks likely to think about calling in their Helocs?
We haven't seen that. I'm not sure if we will see that. I think that would be kind of a doomsday scenario. Obviously, I think there's 2.1 million Canadians have a home equity line of credit outstanding. And I think the average balance in BC is around $120,000. So if they start recalling HELOCs, I think it would be probably a systemic problem. I don't really foresee that. But obviously, it is technically a callable loan. So, I think it's probably a bit of a learning lesson for people to keep in mind not to over leverage that.
Was B20 enacted to protect the buyers of real estate or the banks?
So that's, I think a large misconception amongst the public and the mortgage industry and the developers. The B20 mortgage stress test is ultimately to ensure financial stability within the banking system. So again, it was brought in by OSFI, which is the regulator of the financial institutions. They don't really care if a millennial gets, pushed or stuck from entering the market. They have no sympathy for that. And what they're doing is, again, simply using this as a buffer to ensure that people aren't over-leveraged at a time when home prices, have never been more stretched and interest rates have really almost nowhere to go but up. So again, that's kind of where they are. You see a lot of pundits on the news talk about how this is restrictive of millennials, but again, it's not really designed to protect buyers as much as it is for the banks.
Well, we've also heard from our sources, it's really hard to get a mortgage for a really expensive house, not just for beginners.
Yeah, so I think a big deal with that is as soon as you get over $1 million in terms of a purchase price, CMHC or mortgage insurers in general, they won't insure that loan. So what happens is that loan is entirely at the bank's risk. That's, going to stay on their books per se. And, so it makes the lending more risky from a commercial bank perspective. You can particularly see softness in lending for luxury homes such as West Vancouver. We have home prices there have dropped 25 to 30%. So even if somebody has, say, 30% down payment, that can get withered away pretty quick. And so there's really a lot of illiquidity at the higher end, and that's part of the reason for that is because banks are very cautious about lending on those kind of properties in this environment.
We're hearing rumors the B20 mortgage stress test, which applies to the big banks, could be expanded to include credit unions and private buyers. What are you hearing?
Yeah, that's I saw that report circulating. I think there's some clarification on it today that it's not going to go ahead. I think they would have had a tough time trying to implement that because, a lot of these private lenders, they're making loans based on people's equity. They don't even really care or look at your income. What they'll do is they'll issue you a 12-month loan at, whatever percentage it is. Usually the first mortgage is going to be about 8%. Well, they say, hey, we'll lend you this on the assumption that we're seeing you have 30% equity in your home. It's a 12-month loan. We don't think the home price is going to drop 30% in 12 months when you have to go and renew. And so that's how they lend. So, I don't know, from a regulating perspective, I think it'd be hard to regulate that kind of lending.
With a federal election in October, could politics play a role in any changes to the mortgage stress test?
I think it's certainly possible. As Bill Morneau was coming out last week saying that they were looking to potentially do something to help millennials in the housing market. But again, that kind of counteracts what not only the Bank of Canada is doing. They've been very outspoken about Canadian household indebtedness, trying to raise interest rates. I believe they have had a hand in coordinating macroprudential policies such as the stress test with OSFI and with CMHC. I think there's a coordinated effort. If you look at some of the remarks from not only the Bank of Canada, but CMHC, they're very vocal about encouraging more consumer debt and more leverage into the housing market. So I don't know how, someone like Bill Morneau is going to go against the grain like that. It'll be interesting to see, but I think as of right now, there's definitely a possibility. I think it's less likely.
Isn't the best way to assure home affordability is a strong economy?
Yeah, of course. You have a more creditworthy borrower if everybody's employed and wages are growing. Generally, the strength of the economy is largely tied to the health of the housing market. So if the housing market's strong, sales are strong, prices are rising, it generally has a lot of knock-on effects, such as a wealth effect, people spending on renovations, new cars, because you have this new wealth. But again, as that reverses, it kind of has a counter effect in terms of people feel less wealthy, they'll start to contract their spending. Obviously, there's less commissions and salaries for realtors, mortgage brokers, lawyers, real estate developers. That's a huge chunk of the economy. I think in BC, the real estate construction sector makes up roughly 25% of GDP. So any sort of slowdown in this real estate sector is going to have a lot of knock-on effects.
At the end of the day, are central banks in control of real estate markets by creating easy money, lending out of thin air and lowering interest rates? Then when buying in the market starts to slow, they raise interest rates and constrict the creation of money. Yeah,
I think that's pretty historically how things have gone. Central banks, I think, unfortunately, the general public that aren't really reading monetary policy reports or don't even really care, what a central bank is up to. I don't think they understand just how important a role they play in helping facilitate the rise in asset prices, credit bubbles, and then vice versa, removing that stimulus, i.e. the punch bowl, as things get frothy and as the economy begins to overheat. They always come in by jacking up interest rates and ultimately, pricking the bubble, so to speak. So I think it'll be important to watch what the Bank of Canada does and the U.S. Federal Reserve at the same time.
We'll have more with Steve Saretsky right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Steve Saretsky. Steve, what should policymakers be doing in this kind of real estate environment?
As I mentioned earlier, I think they probably should have put in these policy measures much before prices got out of control. We've been in a 20-year housing bull market, and when you lower interest rates as low as you do and keep them for that long, at the same time you have a massive credit stimulus in China with money outflowing into global property markets. It created, the situation that we're in today. So, but I think, if I'm looking at it from a policy perspective, for the long-term future growth of the Canadian economy, I don't think it's prudent to encourage households to continue to amass more household indebtedness. Canadian households are the most indebted in the G7. The debt to disposable income sits at 170%. Debt to GDP is at 100%. So there's no question that Canadians have had very easy borrowing conditions for the last several decades. So I think it's reached a point now where households are really tapped out. You basically, for the Bank of Canada, they're stuck below 2% and they can't even normalize interest rates, because if they do, you're going to have a lot of households underwater trying to pay off their debts. So I think it would be prudent for policymakers not to collapse to the political pressures, and actually keep in, at least for the time being, the mortgage stress test. And then you can wait and see if obviously things continue to get more and more depressed. You can look at alleviating some of those pressures. But I think right now it's important to keep on going at what they're doing.
After a real estate market has peaked and is in decline, can policymakers turn the market around?
Yeah, and they typically do. What I would imagine we see if prices continue to decline over the next little while, and it could be a year, it could be 2 years. But what they'll do is they'll eventually start to reverse policies in order to get lending to pick back up. My guess is that would probably be a removal or an adjustment to the stress test. It could be increasing amortizations from 25 to 30 years. What you normally see is a lot of incentives for first-time buyers to get back into the market, and that could be in various loan programs. So that's usually what they'll do to kickstart the market. I don't see them doing that again anytime soon, but I would imagine if you do get a substantial correction in the Canadian housing market, that they will reverse a lot of these policies.
Would they do things like reduce or remove the foreign buyer tax?
The foreign buyers tax is, I don't know. I think because there's a lot of political support for it, that I'm a little bit skeptical that they would, pull that back. It would depend, obviously, what government's in power at the time, but I think from a political perspective, governments are always trying to appease the voters. And I think politically and socially, there's a lot of angst, again, right or wrong, there's a lot of angst towards the immigration and foreigners driving up home prices, whether that's deserved or not. But that's where politically things stand today. So I don't know necessarily if that's the route that they'll go, but I think from a macroprudential policy, it's probably the removal of stress tests, et cetera.
When the psychology of a real estate market turns from extremely bullish to bearish, is there any turning back?
It's really hard to do. Generally these, on the way up, you create a positive feedback loop where higher prices, you get higher prices. and people that, are speculating and making money, they continue to double down on that. And, positive news headlines talking about rising home prices, that just encourages more speculation and positive feedback loop. And then obviously it's the reverse on the way back down, where negative news headlines affect consumer sentiment, and that, starts to push prices lower, and then the news will reinforce those declines into the human psychology. So I think it's very difficult to reverse once it's started. I think one of the only ways to do that is again, if you can somehow reverse these policies, i.e. reverse stress tests, and somehow reignite or restart the credit cycle, which I think is going to be very difficult to impossible to do at this stage.
If wages rise at least the rate of inflation, would it make housing more affordable?
I mean, it would help for sure. You'd have rising wages. I think, one of the arguments that I saw to remove the mortgage stress test was an article that came out, and they said, wages are expected to rise 10% over the next 5 years. So, that's 2% a year for the next 5 years. So this will help offset any potential rise in interest rates. But what they didn't factor in was inflation is running at 2% on average each year. So effectively, if your wages are growing 2% and your inflation is growing at 2%, it's really a zero net benefit. You have zero real wage growth. And so that leads to a situation where your debt servicing payments are rising faster than your disposable income. And that is ultimately going to weigh on consumer spending and, is not a positive for economic growth.
Right. And that doesn't take into a factor, property taxes. Everywhere they go up higher than inflation, except in the city of Burnaby, where that's their policy. No tax hikes above the inflation rate, and they're self-financing because they have a huge $1 billion surplus. So do governments take that into account? They keep raising taxes by 7 or 9% on your home, but nobody gets a pay raise like that. Unless you're a CEO.
Yeah, exactly. I think, if you ask anybody in Vancouver, how much do you think inflation is? Well, it's been over the last couple of years. The official metric coming out of the Bank of Canada is around 2%. But again, I think if you look at Vancouver, I'd be surprised if anybody in Vancouver told you that inflation was 2%. By the time you factor in rising rents, rising home prices in the double digits, food costs, gas costs, etc. It's much higher than 2%. But again, that's the reality. That's the world that we live in.
Well, that's because back in the 90s, Canada and the U.S. agreed that inflation figures would not include housing or fuel.
Yeah, they adjusted the housing component of the CPI is very minimal. Not really, I don't think, an adequate reflection. And obviously, shelter costs are a huge proponent of most people's incomes. That's where they spend most of their money is on shelter. And the fact that, it's really marginally included in the CPI, I think is a flaw. But again, that's, they'd rather say, well, the cost of TVs is going down. So, that's deflationary and it keeps
try living in your TV.
Yeah,
try living in your TV.
Exactly.
Or driving your TV to work.
Yeah, no, I think I definitely agree. And hey, maybe inflation's 2% in parts of rural Canada. But certainly in the metropolitan cities such as Vancouver, Toronto, Montreal, there's no way it's sitting at 2%.
Steve, thank you so much for chatting with us.
Man, my pleasure. Thanks for having me on.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. His website, stevesaretsky.com. If you have any questions for Steve or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.